scalping with moving averages remains a popular and effective trading strategy. Although different approaches and tools have emerged over time, moving averages continue to be a valuable tool for scalping traders. The advantage of scalping with moving averages is their ability to adapt to different market conditions. Traders can adjust the periods of moving averages according to their preferences and the characteristics of the asset or market they are trading. Moving averages can be very useful for visualizing the trend in the market. By using different time periods for moving averages, traders can get a clearer perspective of the overall price direction and the strength of the trend. The indicator we will look at today shows a total of 23 exponential moving averages, each with different time periods, ranging from 20 to 900. This exponential moving averages indicator allows us to have a view of the long, medium, and short-term trend. This provides a more complete and broader view of the price, allowing you to take trades taking into account a larger view of the market. The indicator I'm talking about is called expansion of EMA. We can easily find it in TradingView. In its settings, we can adjust its colors, and we will use the distribution of averages for the following purposes. The moving averages of 500 and 900 periods will be to identify the long-term trend. Adjust their color to red. The moving averages of 150, 175, and 200 periods will be used to identify the medium-term trend, and I will leave them yellow. The rest of the moving averages will be used to identify entry points. I will leave them in blue. An entry signal is generated when all the blue moving averages cross each other completely, but these signals must be supported by the other averages they indicate. The rules for a buy are as follows. First, the price must be above the two red moving averages, that is, the 590 periods, and these must be pointing up. This confirms a long-term bullish trend. Likewise, the yellow averages, that is, those of 150, 175, and 200 periods, must be below the price and also pointing upwards. This indicates that the medium-term trend is also bullish. And finally, we observe the crossing of the short-term moving averages, that is, the blue ones. These tell us the ideal time to send the order. When all the moving averages cross each other, that is to say, when the shorter period blue moving average crosses above the longer period moving average, consider this as a buy signal. Conversely, for a sell signal, the rules for a sell are as follows. First, the price must be below the two red moving averages of 500 and 900 periods, and both averages must be pointing down. This confirms a long-term downtrend. In addition, the yellow moving averages of 150, 175, and 200 periods must be located above the price and also pointing downwards. This indicates that the medium-term trend is bearish. Finally, we note the crossover of the short-term blue moving averages. Consider this as a sell signal. If one of the rules is not met, such as if the price is above the red moving averages but below the yellow moving averages, this may indicate a consolidation situation or lack of clarity in the trend. In this case, it might be better not to take the entry signal and wait for all the rules to be consistently met. You can also adjust the average of each average directly in the indicator code. Simply open the code by clicking on the source code option next to the indicator name, and then on Create a Working Copy. There you will see the list of averages with their parameter, which you can adjust according to your strategy.